Hello, everyone. I'm Eugene Ardino, CEO of Lifespan Financial Planning and Chairperson of the Lifespan Investment Committee. And today I'm joined by Jonathan Payne, economist and market veteran of 38 years, as well as author and publisher of The Payne Report. And of course, Jonathan Payne sits on our investment committee as well. Today, we have our first edition of the Lifespan Investment Series, where we're going to talk all things markets, and in particular, we're going to talk about some of the topical issues that we have around the world. At the moment, what's dominating the headlines is the regional banking crisis in the US. And we're going to talk about that. We're also going to talk about what that potentially means for investment markets around the world, both in the US and Australia, what that potentially means for monetary policy, and possibly a few other issues. And then we're going to tie that back to Lifespan's managed portfolios, which we manage and which Jonathan and other investment committee members have an input to. And we're going to talk about how we're positioned in light of some of these issues. So Jonathan, welcome and thanks for joining us. In recent weeks, the spotlight has been on the US banks, in particular the regional banks, with the US bank index down 26% to the end of March. It all began with the failure of the Silicon Valley Bank. And since then, we've seen significant outflows of deposits from smaller regional banks and community banks. My question to you is, can you tell us a little bit about the crisis, and is the crisis over?
Well, thank you, Eugene. It's an absolute pleasure to be with you today, and thank you for the opportunity of speaking to the broader Lifespan family and all of your clients. Yes, as you say, it has been a remarkable month of March, and you hit the nail on the head. The US bank index is down about, actually as of this morning, I think 26% in the month of March. To put that in some historical context, that is equivalent to or slightly more than the kind of declines we saw, guess what, during 2008. So we need to take this quite seriously. Again, as you said at the outset, the kind of catalyst for this was, of course, the failure of the California-based Silicon Valley Bank, which we saw collapse, I think it was on March the 10th. And since that time, we've seen an extraordinary, what could best be described as a bank run, where deposits are leaving principally the regional and community banks. In response to this bank crisis, and I think we can call it a bank crisis because of the extent of the decline in banking stocks. And I just want to say a couple of things, Eugene, and I've spoken to you numerous times in the last several weeks. I had not personally heard of Silicon Valley Bank. I feel a bit foolish, given it was the 15th largest bank in the United States. And another quick footnote is that there are over 3,000 banks in the United States. So you have these little tiny community banks in wherever, Oklahoma and Louisiana, with $300 million in assets. And then, of course, you've got your giants. You've got your JP Morgans, your Bank of Americas, and the like. So let's just try and understand very briefly. So the bottom line is Silicon Valley Bank saw an outflow of deposits. And as with a bank, clearly, if you are seeing an outflow of deposits, then you have to sell down your assets to basically meet the requirements and the demands of your depositors. And with Silicon Valley Bank, they had a very large investment securities portfolio, which they'd basically acquired or invested in around 2020 and 2021. And those securities in the investment portfolio were at considerable losses compared to when they'd purchased them. And when they liquidated those investment securities portfolios, they took a very significant loss, and the market got quite shocked by that. That then set off a significant outflow of deposits from Silicon Valley Bank. And in a single day, the Thursday before they were closed on the Friday, they lost something like 48% of their deposits on that day. So in every sense, Eugene, this very much a kind of typical bank run. And the question now is this going to continue? And really, I suppose, what does it mean for so many of the things that you and I have been speaking about in the last few weeks?
Yeah, absolutely. I mean, those are some shocking numbers. And I guess the question on everybody's mind is, is the crisis over? Is it going to spread? I mean, has it spread much, and will it continue to spread? And what do you think that looks like?
Well, my first observation, and it's very macro, very top down, kind of broad brush interpretation of everything we've seen in March is as follows. First and foremost, I think there will be a significant tightening in lending conditions and, moreover, a contraction in credit, a reduction in lending moving forward. Why do I say that? It's because the very latest data that the Fed produced after last Friday's close, so we'll get another report tomorrow, our time in Australia, we had seen a $120 billion deposit outflow from the smaller banks in the United States. So it's not just a Silicon Valley Bank problem. This problem is right through the community and regional banks in the United States. So what is happening is, first and foremost, the rates they provide or offer on their deposit base are significantly less than the rates available on, for example, short-term US Treasury bills, Treasury notes, and the broader money market funds. So if you're a depositor in a regional or community bank in the United States, you're earning today around 1 to 1.5% on your deposits, when you can go to a so-called risk-free alternative, which are these government or treasury security money market funds, and earn in excess of 4%. Now, there's another twist to this tale. Not only are you not getting as much in return by having your money on deposit with the regional and community banks, you also, of course, are subject to this issue around insured versus uninsured deposits. So if you have less than 250,000 US dollars on deposit, your deposit is fully insured by the FDIC. However, if you have more than $250,000 on deposit, then you are uninsured. You're subject to full capital loss of your deposit. So right now, there is a strong incentive for any customers, depositors, particularly corporates that have money on deposit in the regional and community banks, to transfer that money into perhaps some of the so-called too big to fail, JP Morgan, Bank of America type institutions, or indeed transfer to money market funds, which, as I just said, provide almost double the rate of return with zero credit risk. So if you were the treasurer or the CFO of a business, a small business that banks with your local community bank right across the United States, surely the incentive is for you to move those deposits out of that local community bank. And the latest data, as I just said, and it's a very important number, $120 billion flowed out of smaller banks in a single week. Now, I can go all the way back to the 1970s, and I can look at all prior recessionary periods or times of potential crisis, 2008, of course, the 90s, early 2000, and the early 2000s. At all of those times, we never saw anything close to $120 billion outflow of deposits. So this is important, Eugene, and I do believe that we're going to continue to see a migration of deposits out of the smaller banks, and that will in turn lead to a downsizing of the bank's balance sheets, because again, you're running a bank and you're getting money flowing out of deposits. That's on your liability side, clearly. You have to then sell down a commensurate amount of assets to enable you, the bank, to pay those depositors. Hence, you're going to shrink your balance sheet by selling down assets. And this is really, really critical. And perhaps we should also briefly talk about the facility that the US Central Bank has developed. And I keep forgetting the acronym we've got a world dominated by acronyms, as you know, Eugene. So I'm going to look quickly at my notes. The BTFP, which stands for Bank Term Funding Program, which really is very significant. And I've highlighted this in several, in fact, a few of my weekly pain reports. I, in fact, wrote one on Saturday, which you and I had discussed. And then I wrote again on Sunday. I couldn't help myself because a banking crisis arguably warrants more than just a weekly report. But in essence, what is the BTFP, the Bank Term Funding Program? This enables banks in the United States to basically bring their investment securities portfolio or to pledge their investment securities portfolio and then borrow against that collateral. And what is remarkable is that the BTFP enables you, a bank in Alabama, to bring your $10 billion, with a B, $10 billion, you're a small bank in Oklahoma, or Alabama, sorry, to bring it to the Fed, and they will give you $10 billion in return. They give you they'll lend you for 1 year the par value of those securities. Now, wait a minute. We all know that in the last couple of years, the commercial banking system has seen a massive hit on their securities portfolios because we all know what happened in 21 and 22. Interest rates went up, therefore the prices of treasury bonds and mortgage-backed securities fell. And in fact, the very latest data for the end of 2022 shows that there were $620 billion of unrealized losses across the commercial banking system's investment securities portfolio. But you're this little bank in Alabama, and you spent $10 billion on investment securities, which are now worth $8 billion. So that's a $2 billion hit, right? But it's an unrealized loss. You can take your portfolio of investment securities to the Fed, to this new lending facility, BTFP, and you can borrow $10 billion against that portfolio, when in actual fact, marked to market, it's worth only $8 billion. So if you're running a bank, a regional community bank in the United States, you'd do that trade all day long because, of course, you don't have to crystallize the unrealized losses. Going back briefly to Silicon Valley Bank, what caused the drama at Silicon Valley Bank is that people were taking money out of deposit, and therefore Silicon Valley Bank had to sell down their assets, their investment securities portfolio. They realized a loss. I think it was, what was it, 1.6 or $1.7 billion. And then everyone went, oh my goodness me, we didn't realize you had such huge losses in your investment securities portfolio. And therefore everyone panicked and tried to take their money out. This new lending facility, the BTFP, basically deals with that problem.
Okay, thanks, JP. That's really interesting. What do you think all of this means for the US economy and the outlook for markets?
Well, I think the first, the critical observation for me personally is that all things being equal, and Eugene, as you know, things are never always equal, but we have to use that phrase, all things being equal. You've got a situation where there's a large part of the US banking system is going to be much more conservative, much more risk averse about lending. And so in essence, you're going to see balance sheets contracting and a contraction in credit. And this is really, I think, very, very important. And another thing just to throw into the mix before we move on to the consequences for monetary policy is, of course, everyone is talking about commercial real estate. And unfortunately, there is a huge exposure within the regional and community banks within the exposure to commercial real estate. So this is the next shoe to drop, Eugene, and there's a lot of attention on it. We've been speaking about it, obviously you and I now, for a couple of weeks. The bottom line is the commercial real estate exposure is very, very problematic. And I'm afraid Again, if we look at the general environment for commercial real estate in the United States, it's very, very poor indeed. So therefore, regional and community banks will be even more risk averse in terms of lending moving forward. What does that mean? That means less credit, less lending, means slower economic activity. So I'm afraid I still have the view that we're going to have a recession this year in the United States. And if I had to kind of try and put a bullseye on it, it's going to happen in Q2 or Q3. If it doesn't happen then, I'm almost certain it'll be Q4. What does that then mean, as you ask, for Fed monetary policy? Well, Jerome Powell is trying to thread the needle. I mean, there is a huge conundrum now for the formulation of monetary policy because, of course, we have fears and risks surrounding financial stability. But on the other side, obviously, the US Central Bank is laser focused on this 2% inflation target. At the end of the day, when all is said and done, if you and I were running the US Central Bank and we're keeping a very close watch on financial stability, or at the moment, financial instability, I will guarantee you, Eugene, if you and I were having to make that decision, we would prioritize financial stability in the short term, whilst also keeping an eye on inflation. But at the end of the day, the prioritization would be very much an emphasis on financial stability. And they have gone some way to dealing with that with this, again, I'm looking at my notes because I can't remember all these acronyms, the BTFP, which we spoke about earlier on. So the bottom line for me is the Fed is nearly done. The federal funds rate was raised 0.25%, just what was it, a week ago? Yeah. We're now between 4 3/4 to 5. The upper end range for the federal funds rate is 5%. I've actually always thought that Jerome Powell was keen to get it to 5%. You know what? I think he's pretty much done. I would not be surprised if he doesn't raise rates at the next meeting. I think we've now reached the kind of peak federal funds rate. I now also know, and you know, that, of course, the market is now pricing some fairly significant cuts in the federal funds rate by the end of this year. I think that's appropriate. I do believe as we move into recession, that the US Central Bank will start lowering rates. And I also believe that we have certainly passed the peak of inflation, and inflation now is rolling over. In fact, and I've said this in the last couple of months, Eugene, in my reports, but in recent speeches, I think the market is going to shift from worries over inflation to worries over recession.
Right. And if the market does that, as you say, which I probably agree with, that's probably going to put some sort of, shall we say, safety net under markets. But we've discussed in our investment meetings that the general view and your view is that it's still probably this event, even if it puts a lower ceiling on interest rates than everybody thought, it's still negative overall because of the extra pressure it's going to put on consumers, commercial property owners, and banks generally. So, okay, great. And let's just turn briefly over to Australia. Do you want to comment on whether or not you think such a crisis is possible in Australia? And then, and following on from that, what impact do you think this will have, and perhaps other forces that are going on in Australia will have on the Australian economy?
Yeah, look, this is a really important issue for all of us. Obviously, we're here in Australia and speaking about our Australian banking system. My very, very quick answer and quick response to your question is that the Australian banking system is fundamentally robust, is fundamentally sound, very, very well capitalized. And you and I have had conversations about the regulatory environment here as well, better regulated as well. So look, my quick response to the question, should we be fearful about the fragility of our Australian banking system? My quick response to that is no. I think our banking system is fundamentally sound and fundamentally robust. The caveat, however, is our issue here in Australia isn't so much our banking system. Our issue here in Australia is that the Reserve Bank has been very aggressive in raising rates, and that will inevitably lead to a slowing in economic activity. And that slowing in economic activity, Eugene, is principally driven by I believe, a fairly significant deterioration in discretionary spending, in consumer spending. Why?
Right.
Because as we all know, we've got this phenomenon where mortgages for about over 800,000 mortgages are switching from a fixed rate of about 2% to a variable rate of about 6%. That is a dramatic increase in financing costs. We also know, because the Reserve Bank of Australia has told us, that nearly 15% of Australian households now face the horrible prospect of the so-called negative free cash flow, namely that expenditure on their mortgages and on so-called essential items exceeds their net income. And clearly, as their mortgage costs rise very, very dramatically, as I said, switching from a fixed rate of 2% to a variable rate of 6%, that is really going to put a lot of pressure, very regrettably, on a large number of households here in Australia. That leads me to the view that I'm afraid the Australian economy will also see a recession this year. I know that's really out of consensus, but I am afraid I do actually see a fairly poor outlook for the Australian economy in 2023 into 2024.
Okay. And the banking crisis in the US, is it fair to say that that's probably going to increase borrowing costs around the world, including Australia and other parts, just because the cost of funding, a lot of which is sourced from the US, is going to go up because of some of the other things that you've talked about today? Is that a fair?
Yeah, that's an interesting arena, and it's quite a complex one. I think we can just briefly throw into our conversation what's been happening in Europe, and there we obviously saw the takeover of Credit Suisse by obviously UBS, and that was very much, it was an arranged marriage, if we could describe it as that, with the Swiss government basically orchestrating the rescue, if you wish to call it that, or takeover of Credit Suisse. And also across Europe, we're beginning to see some jitters and some fragility within European banks. Nothing as bad as 2008. So let me be clear about that. But you're right. Banks are going to have to pay up in terms of financing and funding because people are becoming more and more concerned about the banks, particularly, as I just said, in the United States. And you're right. You know, we know from history, Eugene, what happens in the United States doesn't stay in the United States. I mean, we live in a global capital market, and the issue and the problems and the challenges for a large part of the US banking system will have flow-on effects and will ripple through the global capital market. So absolutely. And the other thing is, obviously, banks are having, as you know, to pay up on deposits, because depositors are saying, hang on a minute, you're not paying me enough. I've got all these alternatives now where I can move my money. And banks, you know, the lifeblood of banks is their deposit base, and their, you know, funding through the wholesale markets, capital markets as well. And net, their funding costs are rising, which then puts pressure on their net interest margin, because as we know, by the nature of banking, banks borrow short and lend long. They're borrowing from their depositors, those are their liabilities, and then they're lending to us via mortgages, through consumer loans, and also buying, in the case of many American banks, investment securities such as US Treasuries and mortgage-backed securities. So net, I'm afraid their net interest margins will be somewhat compressed.
Okay, which perhaps puts further upward pressure on consumer interest rates, mortgage rates, and other borrowing rates, I suppose, even though central banks of the world, I think including Australia, are pretty close to the top of the interest rate rising cycle, at least for now. There is talk of perhaps another rate rising cycle if inflation takes off, but we're not going to get into that today. That's perhaps a topic for down the track. I want to turn now to finish off on what this means for an actual investment portfolio, how, you know, what your view is, Jonathan, and also how we're positioned in terms of our managed portfolios for our clients. What can you say about that?
Yeah, absolutely. I think the appropriate and prudential response in terms of portfolio construction in an environment like this is to err on the side of caution, to be more conservative, because we're now witnessing the kind of shock waves and consequences of a dramatic tightening in monetary policy and this really global synchronized sharp rise in interest rates will lead to slowing economic activity. I think it would be remarkable that after so many years of very low interest rates and low inflation and massive monetary accommodation via quantitative easing, I would be shocked if, as we transition from that very lower interest rate, low inflation environment to a higher interest rate environment with higher inflation, that there won't be economic consequences. So therefore, it is my view that the economic consequences will be a deceleration in economic activity. I'm actually going for outright recession. That then in time will lead to, obviously, a deterioration in earnings. So ultimately, when you're looking at building a portfolio and you're looking at the equity side of your portfolio mix, I think we need to really think about the downgrade to earnings, which is now happening in the United States. They were very late and slow to downgrading earnings expectations, but they're now doing it. So lower EPS, earnings per share, basically equates over time to me to lower, a further weakening in equity markets. And on the other side of the portfolio, you've got the realization, and you mentioned it earlier, that the central banks are very close to peak interest rates. And I think the Fed's pretty much done. I think the RBA is pretty much done. I really believe that Philip Lowe doesn't have the heart or the appetite to raise rates anymore. And he's very worried about the housing market. So the bottom line is, therefore, the bond side of your portfolio looks quite attractive because you've got slowing economic growth, slowing inflation, and obviously I've said already that the slower earnings profile. So that leads you, I believe, that the prudent, measured response to that is that you are underweight equities and you are overweight bonds.
Yeah, very good. Underweight equity and overweight bonds. And following on from that, that's essentially how all of our portfolios are positioned. In our tactical overlay, we're extremely underweight equities, probably sort of 80% underweight relative to whatever the neutral positioning is for a client's risk profile. And in our strategic portfolios, you know, we're probably at the lower end of our expected range, which is, you know, probably 10-12% under the neutral benchmark, and generally you'll have a blend of those. So that's the long and the short of it. When we talk about bonds, we talk about high quality bonds. I think it's important to note. So government bonds or really high quality corporate bonds, if you like, you'll probably want to be careful. Would you agree, Jonathan, in the high yield, high risk space when we're talking about bonds?
Absolutely. I think you have to upgrade quality in your portfolio. In this environment, it's an emphasis on quality. And that relates very much to the corporate bond environment. And as you say, obviously, the government securities are the highest part of that quality spectrum. But in your corporate exposures, quality, because defaults are going to rise.
Yeah, and again, going back to our portfolios, we've got a small allocation to high quality corporate bonds, which we recently added, but most of our exposure is in sort of medium to longer durated government, high quality, developed market government bonds. So very good. And yeah, just be cautious out there. It is very difficult to get in and out. One would probably say that where you are now, you'd be careful selling out of equities at this point, even though there is a lot of downside to go. That's something that we sort of manage, and it goes to, you generally want to be careful being positioned this way before a crisis like that. We've talked about historically in our investment committee meetings, raising rates, central banks of the world raising rates until something breaks. Well, something broke in March over in the US, and now we're seeing that. So we haven't actually reacted in our portfolios to this. We've had quite a lot of discussion and meetings about it, but essentially we feel as though we were quite well positioned. So look, thank you so much, Jonathan. Thank you everybody for listening in. Hope you got some value out of that. And yeah, we'll be doing these quarterly. So look forward to talking to you again in 3 months' time, hopefully with more positive things to say. Thank you, everyone.
Thank you.